Ready to talk property the Aussie way? Let's go.
So generally you'd say, okay, if we're saying it's an Aussie couple, mum and dad are both Aussie citizens, then you basically say, okay, whose name should we put the property in? It's then thinking about, the next 5, 10, 15, 20 years of holding this property. Once you return from expat land and return back to Australia.
Expat land.
Yeah,
I like
you
that.
can call it that. And it's definitely very much an expat land,
Yes.
this little bubble that we live in. Those losses will be pegged to that person's name. Can they use them efficiently in Australia? So, you might say, let's say at the higher income earner, you might want to consider putting more of the percentage of the property ownership in their name because those losses are going to flow to them. And in the future, when they're back in Australia, assuming working, they're not, retiring, then those losses will be more useful at a higher marginal rate.
And I suppose someone would come to you for advice or talking about that percentage, because it's not just an arbitrary percentage like, hey, 70-30, let's just do it. I'm sure there's some calculations and analysis that needs to go into how we're going to do that.
How are we going to do it? Yeah. So normally it might be, well, the way I look at it is it might just be 100% in someone else's name.
Yeah.
That's the easiest way to just say, hey, this, out of the two taxpayers, one of them might want to take a bit of a career break, or they might want to do consulting for themselves. Or,
well, they might not be working anyway,
well.
so there is
exactly.
nothing to...
Yeah, there's that point. And there's also the flip side of that to think about, saying if we're going to buy a property with a view that we want to pay off the loan quickly, which is another discussion probably for later today, then, they're going to have positive rental income coming their way. And as a result, they're having income flow to them. When they're not working in Australia, they'll be paying less tax than, say, the other side of the couple that might be on a high marginal tax rate because they're, working for salary.
And then so say we'll go back to the house. They've got, let's put some numbers to it. So it's a $1.5 million valued asset that they've left behind. They've moved overseas to expat land. They've got a loan on it left of, say, $500,000. They've got $1 million of equity in it. Mm-hmm. And so we know the banks will lend out upwards of up to 80% of the value. So then, but they've maybe got some shares and maybe got some other things. But then we're thinking, okay, they might be interested in buying a second property. How does that look from getting some of that money out from a tax point of view out of the main residence into then buying a investment property from a tax sort of
tax
maximising an efficiency point of view?
Yeah, so the taxmen, the way they look at tax deductible debt is they follow the cash. So if the cash comes out of property one, goes over to property two, they'll say, even though that basically cash is secured against property one, the debt relates to property two because that's where the money went. So that's really important to sort of remember those concepts. Eventually when you return to Australia, you've got your main residence, which might have lower debt on it, but you've then got property two, which is your investment property, which has got debt secured against it. If you said, hey, I want to pay off all my debt, then it doesn't matter. But if you want to pay off just your main residence debt, which is normally what I encourage clients to consider, you do that just before you move back into your main residence, because that debt becomes non-tax deductible from that point onwards, which means it's really expensive. It's kind of like you've got to earn money in Australia, you've got to pay the tax, then you've got to pay the mortgage, as opposed to the other way around where you pay the interest, but it gives you tax deduction, so it reduces your tax. So it's always pay off that loan first and retain your investment property loans because they're actually the ones giving you some leverage. But long story short is, yes, you can pull money out of property one or your main residence in order to buy property two, but you just need to remember that property two is probably secured against property one. So if you in the future you are looking at even selling your main residence, you need to refinance so you don't have a drama when you're trying to, sell that property, pay off debt, refinance, and that sort of thing. So keep your loans clean, basically.
Yes, yeah. That's exciting. There's so many questions you can ask, isn't there?
Yeah. There's also the questions like depreciation and appreciation, and how do you look at that? So say you've managed that, you've secured your second property, and you're sort of setting up the right structures for that.
Yeah. What do you do? So let's say you bought it. Let's say it's a brand new property. It's an easy example. So brand new properties have great depreciation allowances. So you can claim depreciation on both the building, construction works, and all the assets inside. So carpets, curtains, air conditioner, hot water service, et cetera, et cetera. So you need to get a depreciation report for that. That's a one-off.
Who provides that?
There's lots of providers, and most small towns have got their own local players. So look, it's now depreciation is one of those things, without getting too tax technical on this call and putting everyone to sleep. depreciation is a temporary timing difference. So it's important to remember that. So if you claim it today,
temporary timing difference.
Yeah, for tax purposes. So that means if you claim it today on your tax return, when you sell your investment property, it needs to be added back to your capital gains tax calculation. So if I claim $100 today as a tax deduction, eventually when I sell the property and I make a $200 gain, I need to add that extra $100 back. So suddenly I'm making a $300 gain. But people say, why would you do it? There's many reasons to do it. So one is you want to, defer any kind of tax liability today, push it to the very last moment you can, which is at the end. Secondly, when you sell the property, it gets discounted generally based on time in Australia. So you'll get a partial 50% capital gains tax discount. And thirdly, if it's your main residence that you're renting out and you're getting a depreciation report for that, it's a permanent deduction in the sense that, if you're going to sell the property, capital gains tax free in the future, assuming you've returned to it, re-established it within 6 years, etc., or you've got some kind of principal place of residence exemption on it when you sell it, there's going to, it'll make sense. So long story short is, without putting everyone to sleep, and you guys are both you're both glazing up at me here. I was like, oh no.
I love the enthusiasm.
I still recommend getting a depreciation report.
Yeah.
And
then talk to your tax accountant and consultant to understand what the next steps are, basically.
Exactly.